I'm not an academic economist. I'm here to make money. So I turn my attention to the tools that will help you do that. That's how you get in front of the data. That's how you front run it. And that's how you make the cash. You got to take a risk. I have no chance against the Fed. They are the 800-pound gorilla in the room. I am flat on their ass. They make the rules. They pull the levers. My value add is to try to understand what they're going to do and front run it and just ride that wave.
Hey everyone, this episode is brought to you by Mantra, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions. You're going to be hearing all about them later in the show, but for now, Mantra, thanks for making this episode possible.
Welcome back to another episode of On the Margin, and joining me today is David Cervantes, CEO and founder of Pinebrook Capital. David, I'm really excited to chat with you today. How's it going?
Good. How are you doing over there?
Doing well. Yeah, a bit rainy here in Canada, but hoping that the summer starts to turn around soon. Well, let's get right into it. We were talking off camera and, we're having a quick discussion about how everybody's trying to have a view on the landing scenario for the Fed and the hiking cycle that we've been through. But you just mentioned that we've already landed and it was a soft landing. Could you unpack that idea and walk us through that analysis that got you to that point?
Let's just, so we have a first principles kind of discussion. What is the soft landing? The soft landing is really a return to the Fed's preferred PCE target of 2% year-over-year inflation for core PCE without breaking the labor market. Now, what does that mean? Typically, when the Fed has gone after inflation for some reason or other, there's been an ensuing recession, and recessions put people out of work. Lots of people out of work, millions out of work. So the Fed's policy objective was to get inflation out of control without causing a recession or throwing millions of people out of work. It was the proverbial getting the fire hose through a needle, and no one thought it was possible. Everyone was waiting for the soft landing. My view again was that inflation was already on the way down. The labor market was historically tight, and that all signs pointed towards no recession. And if we got no recession, then we would not have a breakdown in the labor market. It would slow down, but not break down. And since I made that call in November, we've had exactly that. Behind my view of the labor market slowing down but not falling apart was a view that wages, you can measure them in different ways. I use average hourly earnings, but there's a lot of different metrics to evaluate wages. They started pulling back in January of 2023. That trend was continuing slowly. The unemployment rate was slowly ticking up, but nothing horrific, nothing that would set off, alarms with respect to the labor market. So, just rounding the circle or closing the loop. To me, it just seems that we've already got disinflation, we've already got a softening but not falling apart labor market. We've landed. That's it. We've hit it. Now the rest was semantics and dotting the I's and crossing the T's. But effectively, the policy objective was met back in November. Now, I know some folks will say, hey, we're at 2%. How can this be possible? How can we be, jumping the gun here? My view on that was, the big driver of inflation was shelter. Shelter is notoriously lags, hard to measure. It's a real pain in the butt to understand. It's doable, but I think if you stripped out shelter and the way it's measured, we were basically at target. So that was my thinking there. And obviously, there's a risk involved in these calls going wrong, but that's how you get in front of the data. That's how you front run it, and that's how you make the cash. You got to take a risk. So that was my view, and so far that view has panned out to a T.
So 2 questions from there. First one, if we've soft landed, why do you think the Fed hasn't cut rates yet? And second question, this recent spring, there was a lot of talk about inflation reaccelerating and how we could be seeing that next wave up higher. And we started to see some talk about, originally back then, there was a lot more cuts priced into the market. Now there's less cuts. And, admittedly from the Fed is that they missed that component of a slight, bounce higher. I know you made some arguments about how that's more so seasonal and idiosyncratic, but those 2 main questions that, to me, if we did soft landed, I would have expected both of those to go in the opposite direction that they have. So how do you square that one with your analysis?
There's different ways to measure the rate of inflation. There's the year over year, which is the preferred measure, but then that's kind of, the problem with that is you have lagging echoes from a year ago, right? So if you're taking a June 2024 versus June 2023, how informative is the data from June and July 2023? That's just way in the past. So one of the drawbacks of using year over year data readings is exactly that. Just old, it's stale information. Then the opposite extreme, you've got 3-month moving averages. They tend to be volatile because each component, it's 3 months. So 1 month worth of data will be a 33% impact. So now you have a short data series, very small sample size, and one bad number can throw the whole thing off. So it's all over the place. And then you get 6-month moving averages, which kind of tend to be the compromise for old lag data and neurotic incoming data. Anyway, a lot of these, the 3-month and 6-month moving averages in late 2023 were coming down really fast. And the fear was that if you got a rapid disinflation, it could turn into deflation, which is like a 4-letter word for the Fed. They do not want deflation. It's just bad, particularly for a financialized economy like ours. But the idea was that if we disinflate too fast, nominal GDP would really fall apart. Nominal GDP is what I like to use for measuring the overall pace of the economy. The reason is it's pretty easily observable, and it factors in both real and inflationary growth. And 4% has nominal GDP has typically been the sweet spot for just cruising along. Below 4%, you start getting recessionary vibes. Above 4%, you start getting inflationary vibes. So 4% is kind of my heuristic for and nominal GDP. Now at that point, nominal GDP was, I think, at a 7 handle. So, but the fear was if we went from 7 to something much lower in a really small time frame, then that could indicate a recession on the line. So that's why the Fed was looking at 6 cuts back in December of last year. Was they wanted to get in front of this. Obviously, that didn't happen, so those expectations got dialed back. But that's the way I like to think like a policymaker. What are they thinking? I mean, I have no chance against the Fed. They're the 800-pound gorilla in the room. I am the fly on their ass. They make the rules. They pull the levers. My value add is to try to understand what they're going to do and front run it and just ride that wave. And so, back then with them looking at cutting 6, making 6 cuts, then, I was very bullish on rates. And that kind of, in January, that whole narrative about the disinflation started to change with the January CPI prints. And just the worst thing, the worst case scenario was not going to happen. It looked like.
One question I have is thinking back to this recent June FOMC meeting. It was an interesting one because we had those CPI prints come on at the same day. So it led to a lot of people looking at the summary of economic projections and trying to parse out how related and how up to date it was. There's a couple interesting components that I saw in there. They had an upward revision in their inflation forecast. They held inflation unemployment at 4% for year end, which is like basically where we're at right now. So to me, that sets up some interesting surprises. So looking at a lot of that, and then we look at all the data we've been having over the past month that's been coming in quite soft, like looking at the economic surprise index, it's hitting like 2019 lows. So a lot of downside surprises on economic prints at the same time that it feels like the Fed is making some sort of potential extra hawkish reaction because of what happened to them earlier this year. Do you see that the same way? And how did you square out what was happening in the June FOMC meeting with all the soft data that we're seeing?
Well, let's just take a step back. The Fed is no better a forecaster than anybody else. There are no better forecasters in the market or other private forecasters. They're all kind of looking at the same information and finger in the wind, trying to figure it out. So I don't accept their forecasts or their projections in the SEP as a statement of fact. But I take it as it's a statement of intent. It's what they want. In a perfect world, it's what they get from which they develop their reaction function. So when they raise their core PCE forecast end of 24 from 2.6 to 2.8, they're not saying it's going to happen. What they're saying is were prepared for this to happen. It becomes a game of managing political optics. Now, what does that mean? So yes, all this data is coming in slow. Last week we got these, really bad housing start and permit prints, suggesting and this is, validating my thesis of less activity in the housing market, and that should put a dampener on growth. Um, so my view is it basically buys them. They move the goalposts. It buys them some time, and I don't think we're going to be hitting those levels. So as disinflation kicks in and resumes and reaccelerates, we're going to move farther and farther away from that 2.8. So what that spread does, it gives them more of a license to cut, right? So in other words, if realized inflation starts coming in at 2.5, 2.4, it's easier to justify a cut when your upper ceiling is 2.8 versus 2.6 because that spread is now wider. So it's just really a question of managing the optics. I mean, look, who knows if it comes in at 2.8? But my point is that we know this Fed has a bias to cut. So raising the ceiling and artificially widening that spread between what's happening and what they thought would happen is the green light to say, hey guys, this thing's gotten away from us. We got to cut. So that's the way reaction functions are developed in response to incoming data.
Hey everyone, this episode is brought to you by Mantra, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions into Web3. So you guys have heard me talk about Larry Fink talking about tokenization. You've seen the clips on CNBC. You know that Larry and BlackRock are very, very excited about this idea. And the reason for that is they're looking at these trillions of dollars of off-chain real-world assets. They want to digitize those and bring them on-chain, which is going to be a massive opportunity. But in order to do that, they need a compliant L1, and that's where Mantra comes in. Mantra's been steadily climbing the ranks and now stands among the top 4 RWA projects on CoinGecko, which is representative of its rapid growth and influence in the tokenization space. Mantra's built using the Cosmos SDK, so they have some very cool stuff out of the box. They've got IBC interoperability. They also leverage CosmWasm smart contracts. Very cool design from an architectural standpoint. The next phase on the blockchain's testnet is Hongbai, so that's launching soon. So if you're a dApp developer or something like that, there's a lot of very cool opportunities for you, and I highly recommend that you click the link at the bottom of the show notes. That'll know that I sent you. Thanks very much again, Mantra, for making this possible. And again, guys, click the link at the bottom of the show notes.
That's what I felt too, is that based on what they put in those projections, basically it's set up a lot of opportunity for dovish surprises and makes the level to hit for a hawkish surprise extremely high. When they baked in the base effects for the summer, the unemployment rate is where they forecasted it, that it's going to be like not that surprising if we get above that by year end. So when do you think this first cut happens? Do you see it in July, September, or even later?
The answer is my base case is September. But if we get a really horrific, horrific is kind of it's a subjective word, but let's just say we get any reading above a 4.2% unemployment, U3 unemployment, between now and August will trigger a SOM rule violation. So SOM rule is if the previous 3-month moving average of inflation is more than 50 basis points greater than the lowest 3-month moving average within the past year, then we're getting a recession. So right now that level is 0.37. Even if the unemployment rate does not change, that number will increase just mathematically. It's going to increase due to base effects, and will probably be at a 0.4 handle. But a 4.2 U3 unemployment rate would definitively take us above 0.5. It will be a violation of the SOM rule, and the Fed will be in a real pickle. I think it's a fade, but the Fed will be in a pickle of, they have a prominent former economist whose rule has been, it's been vetted internally by the Fed. They have it listed on their Fed website. Everyone's using it, and they would be remiss to, have this big flashing red light and then not do anything. So to answer your question, if we get a 4.2 U3 print anywhere between now and August, they will probably cut in July. Not probably, they will cut in July. They will not. The political optics of having this flashing red light and them not doing anything would really put a lot of egg on their face.
I'm super curious why you think that some rule triggering is a fade, and is it related to your view on there being no recession, and more so this is just a short to medium term slowdown? And is that some rule being and basically the anchor to that is the unemployment rate, and all we've heard a lot of talk about how the supply of labor has been going up a lot for a variety of reasons. Some think it's immigration that's just quite above trend right now. Is that why you think it's a fade, or if not, why do you think it
So
is?
yeah, there's two reasons to fade. One is by August, base effects will kick in, and the SOM rule will commence a downward trajectory after August. So I think a lot of this is just kind of measurement error. Uh, and the other thing is the source of that measurement error is, of course, policymakers rely on the U3 rate. The U3 rate is based off the household survey. The household survey is, it's a household survey. It's phone calls. Um, we got two pieces of data that conflict. The NFP prints, non-farm payrolls, they've been coming in quite strong, above expectations for months now, suggesting that the labor market is great. Problem with the U3 is that it's been, unemployment bottomed at 3.4% last year, and it's been ticking up since, slowly but ticking up. And I think the measurement errors with undercounting people or overcounting people, and reconciling the two data sets, I think it's just too, given what else is happening in the economy. I think it's just not gonna. It'll be a false positive. It's a very, very tight window that SOM would be in effect. And I think, given all the measurement errors and everything we have going on in the economy on the good side, I think it'd be a fade. So if we were to get this readings that are sub zero point 0.5, but still increasing from the current 0.37, that's the fade. If we do get something that clearly violates and motivates the Fed to cut, then the trade is, you ride that wagon, you get behind the Fed, and you don't fight the Fed, and whatever policy reaction function, you attach yourself to it.
Tying in this discussion around the labor market, would love to circle a bit back on, you mentioned you largely look at nominal GDP as opposed to real GDP. Um, Going one layer deeper on that nominal GDP, I've seen over the last few years, there's been some pretty noisy prints in that, especially around net exports. Like a couple of years ago, we saw those 2 quarters in a row where the negative net exports number created a negative GDP print, and there's a lot of folks saying, "Oh, we're in a recession," and Biden was on the other side saying that, "Oh, we're not in a recession." It's more than that. And a lot of that was driven by that weirdness around net exports. So I'd be curious, like looking at either consumption, private investment, government spending, or net exports, like where's your analysis on where GDP grows, and what of those baskets are you looking closely at?
So I don't even bother with the baskets. I just look at the whole number of nominal GDP. That kind of just
Mm,
dispenses with all the
okay.
noise. I think it's
Yeah.
a problem with the way economics is practiced is we get lost in this minutia. And for me, NGDP kind of just removes all that noise and gives me the signal. And that signal is, if NGDP is above 4%, then there's a very high probability that we are not in a recession, nor will we be in a recession. So back in 2022, when real came in, flat or negative for some of the reasons you mentioned, nominal GDP was not printing sub 4%. It was higher than that, partially because of inflation. And so I did not see a problem with that.
Is that what you use to measure restrictiveness too? Like, say something like looking at the spread between the 10-year bond and nominal GDP? Or, I know there's been a lot of talk about our star and the neutral rate and people trying to figure out, are we even restrictive or not? How do you look at that?
So yeah, so first an R star. R star is the animal in the forest we've never seen, but we've convinced ourselves it exists because we've seen the footprints and maybe some droppings there. So it's one of those elusive concepts that it's a nice shiny toy model, theoretical, but a lot of the drivers of R star are long term in nature and structural. What does that mean? Demographics and productivity. So you're not going to get, in any given 1 or 2 year window, changes or estimated changes in R star really don't matter because those are glacial developments. So I think the whole argument around what R star is kind of it's a great academic discussion. It's great for, whatever, but for making money, it's worthless. It's just you don't make money off trying to trade off what our star is or will be. It's a waste for trading. It's a waste of time. So I don't pay attention to it. I'm not an academic economist. I'm here to make money. So I turn my attention to the tools that will help me do that. And our star is not one of them. I'm sorry. What was the question before that?
Just looking at, like, say, measuring restrictiveness, do you look at, say, the spread between 10-year yields and nominal GDP or something?
I just look at nominal GDP. It's really what it comes down to. The problem with spreads or nominal 10-year nominal levels is that there's a lot of different things going on with that. I don't think they matter super long term, but things like risk premiums, things like supply. Look, I don't think those matter in the grand scheme of things, but short term they do cause fluctuations, which makes reliance on a 10-year very, very noisy and hard. For me, it's really nominal GDP. I am known on Twitter for being a big fan of nominal GDP targeting. I do think it's the easiest, most practical, effective measure that we have of a lot of things, including restrictiveness. So, if nominal GDP is slowing, then you do have restrictive conditions. Now, you can pick your fight about is it enough or where is it going to go from here. But I think nominal GDP, broadly speaking and roughly speaking, does a pretty good job of letting us know of how restrictive things are. And that kind of just mirrors my basic approach to macro. I like to keep it simple. There is so much data, there is so much of this and that. And I think, macro as a practice really has to focus on the big picture and on a few key things and understanding them well. And if you can do that, I think it's doable to have potentially a small edge in understanding macro. But yeah, I try to get it too much in the weeds of the details of the indicators, because for every indicator, there's 10 other indicators that give you a different story and just creates noise.
Well, that's what I really appreciate about your analysis is, you have the macro background, but you're not stuck in the big multi-generational, the death of the dollar type stuff. And, it's interesting to talk about, but at the end of the day, you're here to make money. I'd love to spend, we spent the first half of the show talking about these sort of wonkish economic data points, but would love to spend a bit more time talking about, okay, how do we move the bridge towards action as a trader? You've done a really great job at trading the long end bonds. And that's been obviously really great. Would love to just hear a bit more about, what are you trading in that long end? What's your forecast for the next while? And what are the drivers that you look at? I know there's been a lot of talk about, especially on Twitter these days, about how, the long end is going up much higher because of negative term premia. And, we have all this debt issuance on the fiscal side of things. And I know you've been a pretty strong fader, and that's been working really well over the last month or two. So would love to just hear a bit more about, from somebody with a background in fixed income trading is, what are you looking at and how do you manage that risk and execute?
I think the first step really is to understand the growth and inflation matrix. That is going to be key, because the growth and inflation matrix will determine the Fed's reaction function, and that will determine the shape of the yield curve. So, it's really just understanding those two things first. That's kind of a first starting point for me is what's inflation going to do, what's growth going to do, and how will they interact to create, different Fed reaction functions. So right now, my thesis is growth is slowing, still positive. It's not recessionary degrowth, but it's slowing. Disinflation is resuming. It will probably accelerate. So that makes me think that the Fed will lean dovish. I think that gives them the bias to cut. So then now I think to myself, well, okay, this is where the rates are. This is where I expect them to go. This is how I expect the Fed to react to that. And then I project forward and try to see where the puck is going and then develop a trade off of that. I mean, there's different ways to monetize the same thesis. I know that it all depends on your risk preferences. I've been playing the long end on tens, but I think, playing twos as a proxy for what the Fed's going to do has been an equally fabulous trade. And if you're able to lever that up, then you can get similar returns to make up for the lack of duration on twos versus tens and get a similar kind of payoff. So it really comes down to summarize, growth and inflation, Fed reaction function, and what are you looking to do, and do it outright organically. In my case, I like tens, or do it a different way, twos, leveraged, and get a similar payoff profile. But from that, just general building block fund. To me, that's that whole what we just discussed is a foundational building block for everything else. Is everything trades off of interest rates and the Fed. I mean, obviously, the real economy does its own thing, but in the short term, that's how I approach the problem set. But you can take the same, once you've got that foundational approach down, you can say, well, if rates are going to go down, that's bullish for the rates complex. Another trade that to look at is mortgages, right? Mortgages, mortgage spreads are, they blew out when the Fed started raising rates, and the yield curve inversion really messed around with mortgage spreads, raised volatility, and for those readers out or listeners out there, mortgage MBS, mortgage-backed securities, the owner of a MBS is short a call option, right? So you're as a homeowner, you can prepay your mortgage. You can say, you got a windfall, you win the lottery, you got a bonus, whatever, cash out some stock. You say, what, I'm done having a mortgage, I'm just going to pay it off. So that's great for you, but for the bondholder who's relying on a stream of monthly payments, that's bad because they've locked in a fixed return yield. They've locked in a yield, and if you prepay your mortgage, then they are no longer going to get that yield. They've lost out, and if rates have gone down, now they have to buy paper at a lower rate, which is more expensive for them, a lower yield. So anyway, my point is that if you're a mortgage-backed holder, if you go out and buy mortgage-backed securities, and rates are going down, the volatility on the short call option will go down, and that's good for you. So, mortgages are another expression of the same thesis. Then you can get into mortgage REITs. I actually got long of those back in November of 2023. The trade's been it's been okay. The easy money was made Q1 last year. I think NLY, the instrument I've been using, NLY Mortgage, it's up 4% year to date, but it also had like an 11% yield.
Yeah. Are those agency MREITs?
Yes, correct.
Yeah.
Correct.
Cool.
So, you can capture, you can monetize the economics differently, obviously, with those kinds of dividends, you have tax issues. But, it's just it really comes down to who you are as an investor and what you want. But getting the interest rate call down, getting the rate call right down is kind of the key foundational act for any trade you want to put on after that.
So a few things to go off of. So obviously, say, for example, I don't know what the 10-year is trading at today, but if you expect it to go, the yield to go lower from here, do you typically play that in like futures, swaps, FRAs? I know you said you don't really like looking at spreads, so I imagine you don't really play steepeners that much, or maybe you do.
I would say I keep it simple and just go outright, and I use futures because there's a lot of leverage, and they're also cheap to transact, and you can transact them, almost 24/5. I think it's 22 hours a day or something like that. So it's a very liquid, deep, transparent, cheap market to transact in, especially for the retail investor. To go short bonds, if you try to do it through a regular brokerage account, you can't do it because you have to borrow bonds to short them. That requires all these, fancy margin facilities. Name is called
because there's no like TLT offering for the 2-year, is there, or like something really easy like that, or is there?
There are, I believe, TUA is an ETF that focuses on the short end. I'm not sure. I mean, I just use futures, so I'm not really versed in the ETF universe. Yeah, so I prefer the futures market. It just works well for me.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back Permissionless. We're going to be doing Permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram, Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for DAS this year, and I hope to see you out in Salt Lake for Permissionless. And because y'all are such faithful listeners, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there.
A couple other questions I have on just how you actionably trade and analyze the bond market. Do you look at any of the components, say the fiscal situation? How much does that go into your analysis? And then also, a lot of people look at things like what is happening with liquidity flows in and out of facilities in the Fed, like the reverse repo and things happening with the TGA account and stuff. I know, like you mentioned, you like to keep it pretty simple, but we'd be curious. Do you look at those things? Do you have thoughts on them, and do they drive your risk framework?
The answer is no and no and no. I don't look at them. I don't look at them. It's tomorrow. It's tomorrow's problem. I mean, obviously, the fiscal thing is an issue, but I mean, I'm a little older than a lot of your viewers. I swear to God, since I was in middle school, I've been told that the deficit's going to, throw this country into oblivion, and that my children and grandchildren are going to be starving, when time comes. And now I'm no longer in middle school, and the worst of the worst hasn't happened. So now things change, and the fiscal situation, especially after COVID, with the fiscal response, where we threw World War II, levels of government spending at the problem, and rightfully so, in my opinion. But that has to be dealt with, and the projections are not looking good within the next over the next decade. But that's a political problem, and political problems are hard to trade in a short time frame. So, it's a problem. It's a political problem, but it's not one that I can trade around them. And in terms of the RRP and flows, I just, typically, I think it's kind of the tail wagging the dog kind of thinking. I ultimately, growth and inflation went out, and if inflation falls, rates will rally. Period. Full stop. End of story. The flows, they'll come back. They'll chase the bonds. That's what matters. Same thing with growth. So it really comes down to, I think, if I have an edge in understanding inflation and growth, then I focus on that, and I just put everything else aside. Eventually, all those flows, all those things will work themselves out, and chase the value of the bonds if they are offsides from what's happening in growth and inflation land.
Nice. Yeah, I really like that approach. Shifting gears to equities, do you have a view on them? Do you trade them? What drives your analysis of where they are? Obviously, we've seen a really huge rally over the last year that's taken quite a few people that were expecting downside by surprise. What's your take on them right now?
So yeah, so I do trade equities broadly, just S&P 500 futures, E-mini, SPOOS futures. And that goes back to my basic approach with fixed income. It really comes down to growth and inflation. So equities are highly correlated to nominal GDP, and the reason is nominal GDP is a proxy for. Stock revenues, equity revenues are a proxy for GDP growth. So if NGDP starts to accelerate, then you're going to get top line growth for companies. Now, obviously, the opposite can happen, where NGDP slows and equities can still be fine, right? NGDP has been slowing, but earnings have been rising, inflation has been falling. It's been kind of a Goldilocks environment for equities. As long as the business cycle is strong, as long as a recession doesn't look probable, as long as inflation looks stable or falling, I think it's a risk-on environment for equities. Now, that said, I am projecting a slowdown in the economy, so it's possible that current earnings may have to get reduced. We'll see. So I'm not bearish equities. I'm not saying sell. I'm not saying I'm selling. I'm not doing anything like that. But here I'm probably not chasing a whole lot. The
Yeah.
easy money was already made. But I approach equities similar to how I approach fixed income, which is understanding growth and inflation.
Yeah.
And I just something that's a little more nuanced. A lot of people they overemphasize interest rates on equities. What I mean by that, since 2018, rates are up, several hundred basis points, yet earnings are also up over 55%, and the stock market's also up commensurately. So, it's not a one-for-one relationship. There's a lot of nuance in there, and a lot of that nuance depends on time. So rates being up, a few hundred basis points since 2018 over a 6-year time frame is a lot easier to digest than rates going up 600, a few hundred basis points tomorrow. So that needs to be contextualized as well. But I do think people overemphasize, overweight the role of interest rates on short-term equity flows.
Yeah, that's interesting to me because it seems like there's obviously that one side where it's just like, okay, these are just the present value of discounted cash flows, and those cash flows are nominal; they're not real cash flows, generally speaking. So when you have some higher inflation and a higher end GDP, it makes sense that those perform well. But on the other side of the equation, I've heard, okay, right now, like you mentioned, we see a slowdown coming. Yes, that could be bearish for growth, but that also means that people want to pile into longer duration assets, and equities are longer duration. We've seen tech perform really well. Could also see an argument made that if you want to buy some duration, go buy Nvidia or something like that. So are you saying that that shouldn't be as paid much attention to, as opposed to, say, the core fundamentals of earnings growth?
Yeah, I mean, you're right. I mean, equities are long duration instruments. They have in theory, especially at the index level, an infinite number of years of cash flows, right? So, does a one bad year, bad quarter, or bad 2 years really matter in the grand scheme of things? The answer is not really. So, um, I think for equities, it's really about understanding the overall earnings power of the firm or the firms in question. So again, I think people overweigh interest rates and this whole duration concept. We were told that, well, high duration instruments like tech shares, or you get smashed with the rise in rates. Well, guess what? It hasn't happened. So I think that link is overemphasized in my view.
Mhm. I know you don't trade single stocks, but does the market breadth in this rally worry you at all, or do you just mostly stick to the index and let it run?
The answer is not really. Since 1990, breadth in bull markets has been, not wide. It's been, um, you know, what we're seeing happen today with, the Mag 7 names. We saw happen with the FANG names before the pandemic. We also saw it pre-global financial crisis. We saw it .com. I mean, .com was more widespread, but in every cycle, you're gonna have a pretty narrow driven rally by the biggest and the best. And in this country, they happen to be, since 1990, they've been all these tech names. That's what it is. So I don't fight it. It is what it is. I don't question it. As long as the index is doing well, aggregate earnings are doing well, the aggregate economy is doing well, then that's what matters.
Do you look at foreign exchange at all in terms of like driving your macro analysis, like, say, I don't know, interest rate differentials leading to higher flows into U.S. equities or anything like that?
Not really, because with the dollar being the reserve currency of the world, it kind of sets the tone for everything else. I think what really drives the flow into U.S. equities is not so much rate differentials; it's really you know the quality and the earnings of the companies that we have. I mean, you heard all these stories last week about how Nvidia is now bigger than the German and French stock markets. It's just these world class companies that we have. Um, that's what drives return. That's what drives returns. If you're a sovereign wealth fund in Norway or Saudi Arabia, and you got to put money to work, you first of all you need a big deep liquid market that you can do that. And the U.S. offers the biggest and the deepest liquid markets in the world. So there's other attributes and other factors that draw capital in aside from interest rate differentials.
Looking at the rest of the year, I would love to just hear a few. We probably talked a bit about a few of them, but what are the key signals you're looking at, and what are the key pieces of noise that you're looking to fade and not really pay attention to for the rest of the year?
Yeah, I mean, I think the real signal is going to be on the inflation data, and that's gonna drive the Fed policy reaction function. Similar with the employment data, I think the Fed at this point is going to prioritize the labor market over the inflation issue. Why? As I said, inflation's pretty much done. You got housing; it's a pain in the butt. It's kind of a thorn on its side, but really at this point, the Fed, especially with as the U3 starts flirting with the Somme rule, I think the Fed's really going to be on guard, and they do not, as proponents of the soft landing, they really are going to try to, make sure this thing sticks and make sure they don't, what's the term? Snatch victory from the jaws of defeat. They've won. They just got to not screw it up. And I think not screwing up means we don't get a recession while the economy continues to disinflate. So inflation, labor market, obviously with that comes earnings. And those are the real core things. All these other things about the election, the election is noise. I think that's gonna be a real noisy thing. I would just not even worry about it.
Yeah. So you're just totally missing it and just letting it do its thing and sticking to your core.
At the end of the day, the answer is yes. There'll be a lot of noise about whose fiscal plan to do this and that, but until the election takes place, it's just a distraction in my view.
Yeah, well said. Well, look, really enjoyed our conversation, David. It's great to connect. Well done again on everything this year. You've really nailed a lot of these turns, and really look forward to seeing how things formalize for the rest of the year.
Thank you. And just one minor editorial correction. You said my Substack was Pinebrook. It's actually Pinebrook Cap. So
Pinebrook Cap, and we'll have it in the description as well, so people can head over there and check you out, because you do some really great work there.
Thank you. Appreciate it. Awesome. Thank you.
Thanks.
Cheers. Bye.